Acquires funds. Tobias, so much to talk about. Where do we start?
Well, energy, I think, is the big story with the ongoing attack on Iraq, on Iran, rather. The oil price has been extraordinarily volatile. Over the weekend, it went to $118 WTI. Uh, Oil went to $112. By the close on Monday, it was back below $85, and it's been volatile ever since. Anything north of $80 is great for domestic oil producers. So the curve also now seems to be anticipating perhaps a longer conflict, or at least higher prices for longer, which is great for domestic oil producers. So I think that while the attacks are awful, the prices for domestic producers are great.
Let's talk about what certain price levels mean in terms of the economy, who benefits, who doesn't. At $80 a barrel, you say that's good for domestic producers. We can all agree on that. And there are probably not any significant knock-on effects for consumer prices in this country. At $100 a barrel, where we are now, that's a different equation. It's good for producers. It starts to hurt consumers. We're seeing it at the pump right now. At $120 a barrel, as we had over the weekend, markets start panicking a little, and God forbid we get to 100 or 200, 150 or $200 a barrel, like Iran is threatening. Even if that were to happen in the short term, what would that mean when you get to price levels well above $100 a barrel?
Well, it's definitely a handbrake on the rest of the economy, and the oil as a feedstock for the rest of the economy it's extraordinary the extent to which it does permeate through everything from food to chemicals to anything that has plastic in it and so on. So yes, it's an impact on the consumer, um, and the longer it goes on, the more it will become embedded at settled at a higher price. So it'll certainly have impacts on inflation, and that will also mean that probably rates have to go up too. So it's because that seems to be the Fed's approach when there's an oil price spike. They do seem to increase rates into that because they interpret it as increasing inflation, and they use rates as a handbrake. So it's entirely possible that that it is a catalyst for lower equity prices, and the equity prices that are most likely to be impacted are those at the very top end of the curve, which are extraordinarily expensive at the moment.
So let's talk about where the risk lies right now. Obviously, there are many sources of potential risk, and it's difficult to assess each one. But what are the triggers right now for the market? What is it that you're watching that you're concerned about when you think about sort of the negative externalities of this?
Well, the the risk for the compounders, the growthier companies, the tech stocks, has been that their valuations have been so stretched. So if rates increase dramatically, or if there's this slowing in the rest of the economy, it's hard to see how they will avoid that just on a valuation basis, because they're trading at the entire S&P 500 trades at close to 40 times CAPE, cyclically adjusted price earnings, which is an extraordinarily high number. We really only saw that in the very tail end of 2000. The rest of the economy is also impacted because the mid caps and small caps are more sensitive to economic activity, and particularly to higher rates. And so it's entirely conceivable that it drags down the entire markets, the equity markets particularly. So it's something that I'm watching the earnings pretty closely of anything that uses oil as a feedstock. Uh, while it might be a good thing for there's this sort of Goldilocks price, which might be below $100 but above $80, which, because we're largely domestic producers of oil now, it seems to be a reasonable positive or a wash for the economy. But beyond that, it becomes concerning, certainly for small and mid companies.
Of course, we're speaking with Tobias Carlisle, founder of Acquires Fund. Tobias and I speak on a weekly basis to discuss energy markets and more. Tobias, what are the defensive plays right now that you're favoring? Where should investors look for safe haven?
Well, oil and gas, even though those prices have run up pretty materially since the start of the year, between 20 and 30% in those equities, I've been saying that they have been undervalued for a very long time, largely because the oil price has been so low. The oil price was below $70, which is supply destruction. There's just been no new creation, or there's been very little investment in oil and gas, and so uh, those equities have looked reasonably cheap. And as the oil prices run up, they've followed suit, but they still continue to be cheap on a if your time horizon is longer, is 3 to 5 or 10 years. They still occupy a very small portion of the S&P 500, where they've been quite a large portion in the past. So I think that oil and gas is still interesting here, even though they've run up a little bit. And then the other areas, I had been saying that the consumer has been struggling a little bit. The risk is that gas prices spike into this, and gas was also feeds into foodstuffs and various other parts of the economy. So it's tough to find a defensive spot at the moment, but I think that consumer cyclicals have been pretty beaten down, and so there's still a reasonable place to dig around in there. They're names that they're not going to be particularly exciting names. They're small caps that haven't sort of participated much in the rally so far, but I still think that they're on a long run basis, they're pretty cheap. They're trading at a big discount to the large caps, and so they may not be as impacted quite as severely as the large caps are.
Tobias, tell us about the funds you run.
I run two, ZIG, which is a mid cap, large cap, deep value domestic US equity, and Deep, which is a small and micro. They've both had a long period of not participating in the very techie part of the market. They're more heavy industry. And so the cycle in the market seems to be from tech to heavy industry. And we've had a long tech run. And so it's entirely possible that the heavier industries and the cyclicals participate here and that's what we saw in the 70s when we saw the oil price spike. It was a good period for small value. And so that's where I think the next 3 to 5 years is.
Thank you so much for joining us as always. Where do we follow you? You're pretty popular on social media.
I'm on Twitter at Greenbacked. It's a funny spelling, GREENBACKD, or acquirersfunds.com.
Tobias, thank you so much for joining us. We hope you have a wonderful week ahead.
Thanks, Janet.
Take care. That's Tobias Carlisle, founder of Acquires Funds. Thank you, Tobias. Good luck. I hope
Thanks.
you make a lot of money. I hope you're making a lot of money
I,
out
I
there.
hope we survive.
All right, take
Thanks,
care.
Janet.
Bye
Bye.
bye.